Hey traders, Jason here from Leavitt Brothers. In this video, I'm going to do an update on my State of the Market series. It seems like we have a lot of cross currents to deal with. Some stuff doing well, other stuff not keeping up. Rotation between groups has been pretty extreme, whether it's oil or other commodities or tech or real estate. Groups have trended hard in both directions. And of course, inflation has moved up enough for the Fed to finally recognize it. So in the end, we're just going to follow the charts. There's no point in guessing what's going to happen unless there's like a sudden event like the virus breaking out last year. The charts are a pretty good guide to follow. So first I'm going to cover the weekly index charts, and then I'm going to talk through some breadth indicators. All right, let's get started here. All right, so here is the S&P 500 weekly chart. Super strong, super bullish. Ever since the low last March, we got support from the 21 EMA, which is the orange line. Support there, support there, support there. We got higher highs, higher lows going back more than a year, trading above the 21 moving average overall and trading above the 8 moving average on shorter term. The index could fall 100 points easily, even more than 100 points, and still be in its uptrend. So if tops take time to form, we're not even close, because the S&P hit a new high last week. This week it's doing well. It's only Tuesday, but it's doing well. You can't be anything but bullish when looking at this chart. Here is the NASDAQ, which is equally bullish. Since the March low last year, it moved up, consolidated here for a couple months, moved up, and is now trading in a fairly large ascending triangle pattern. This is super bullish. Okay, if this was a stock, you'd be buying dips within the range, and then you'd be adding on a breakout. And actually, it is a stock. Well, it's not a stock. You can trade the Qs or the triple Qs. This is super, super strong, super healthy, everything in great shape here. There are no warnings. The NASDAQ's in fantastic shape. Last index chart, this is the S&P 600 small cap weekly chart. It too is in good shape, moved off the low, consolidated here, trended up with force. It lagged over here, but then when this happened, it took over a leadership role. So now we have higher highs on higher lows. We had the appearance of like a wedge. Sometimes rising wedges like this within an uptrend can result in a move down. It's possible. Okay, if this upper trend line was more like this, then you'd have more of a channel, which has a tendency to continue on. However you look at it, we have higher highs, higher lows. The trend is obviously up. Okay, the 21 is the moving average here that's going to come into play. So you can't be anything but bullish here. Okay, bullish with stops in place is the way to be. There are no major warnings here. You can't guess that there's going to be a top sometime. Like with this kind of a formation, with the chart moving up, with higher highs and higher lows continuously being made, you can't be anything other than bullish with stops in place. Now you could be super bullish and have big positions. You can have you can be cautiously bullish and have smaller positions and tighter stops. But either way, I don't see any reason to be anything other than long, based on the weekly charts of the S&P, the NASDAQ, and the small caps. All right, now let's look beneath the surface at some breadth indicators. All right, so here is the S&P 500 up top, and what we have here is we have the 10-day moving average here, 20-day moving average here, and 50-day moving average here of the NYSE 80 line. So characteristic of an uptrend is you get up and down movement within a range mostly above zero. Okay, market expands and it contracts and rests. The market expands and it contracts and rests. And when you get this flowing, when the 10-day moving average of the 80 line just kind of moves up and down like this, mostly above zero, that is characteristic of an uptrend, and you should be long. Now, how long you are, that's for you to determine, but you should definitely have a long bias. Same thing with the 20-day moving average. Characteristic of an uptrend is you get, up and down movement mostly above zero, and that should keep you long. And you can see the 50-day moving average has been oscillating up and down at an elevated level. Now, within that, within those ranges, within this, this 10-day moving average is going up and down, you get divergences like this. which lead to, minor pullbacks that could last a few days or a week or so. That happens. We got something over here, which caused this, or at least partially caused it, divergence there, same thing. So characteristic of an uptrend is up and down price action, or up and down, I guess, data within a range at a relatively decent level. That maintains your overall uptrend, and then within the uptrend, little divergences cause minor pullbacks. Okay, and this is exactly what we have. So per the AD line, everything's in great shape. Here really quickly is the cumulative AD line, higher highs, higher lows, trending up. There's absolutely no question that advancers over time have been consistently beating decliners, and this supports the market. All right, so now here is the NASDAQ versus the NASDAQ 80 volume line. Okay, so the 80 line allows all stocks to participate equally. It doesn't matter if you're Apple or some small cap stock, you count the same. With the 80 volume line, obviously, like, the bigger companies that trade more volume have more influence. So, sometimes you get a little bit of a different story. It's not a perfect indicator because you have expensive stocks like Amazon, which trade less volume than a much less expensive stock of a company that is actually much smaller. So it's not perfect, but it's still pretty good. So we have here is the 10-day moving average, 20-day moving average, and 50-day moving average of the NASDAQ AD volume line. So similar to the AD line, we tend to get within an uptrend, within a strong, healthy market, you tend to get up and down movement within a range at a decent level. Okay, this indicator tends to be a little bit more volatile than the AD line. It's just the way it is. So what we got here, so just as an example, like here was the market was really strong, and we just got rotating data up and down within a range above zero. Looks good. If we look at the current situation, we did have some weakness here where the indicators were trending down, getting lower, below zero. And what happened is the market actually did, and we did get a pullback here that lasted like 2 weeks. But then the indicators broke out. The 10-day and 20-day broke out to, out of their little falling patterns, and they matched or exceeded their previous highs, previous high here, previous high here. So that kind of resets the clock at zero, and we start over again. Okay, so per the NASDAQ 80 volume line, market's in good shape. The 50, a little bit more concerning because it's dropped to a low level and hasn't completely recovered yet. But short term, this looks to be in really good shape. Next up this is the cumulative 80 volume line. Obviously, doing really well, trended up with force for the last 3 quarters of last year. The upside momentum slowed down here, but then it picked up just at the beginning of this month, end of last month. So looks good. Okay, advanced decline line, advanced decline volume line, very good shape. Support those weekly charts. Now let's look at a few that aren't quite there, but are still doing okay. So here is the S&P 500 up top. This is the S&P 500 stocks above their 20-day moving averages and above their 50-day moving averages. Okay, so S&P makes a new high here, and we have 90% of S&P stocks above their 20-day moving average. S&P 500 makes a new high here, but now only 80%. S&P 500 makes another all-time high there, and now it's more like 60%. Okay, so less and less participation. Same pattern exists with the stocks above their 50-day moving average. S&P is moving up and up and up. Less stocks are participating. Then we got a big plunge at the end of last week, okay, with both of these indicators. So the question is were these drops last week enough to allow the market to let out some air and to reset? Okay, that's the big question. I don't know the answer because we got dips here and here, but look at how much the S&P dropped in order to produce those dips. We got a decent dip here, and it didn't really move down that much. And then, of course, last week we had a decent dip here, and it like literally didn't move down at all. Well, it did, but not much. Same thing with stocks above their 50. Dips here coincided with 2 to 3 week pullbacks. But last week, this didn't really coincide with much of anything, just a small dip. So the question is, was last week's dip enough to produce a tradable bottom, or do we need to let out some more air? Do we need to have a bigger something like this, which actually lasts a couple of weeks, or do we actually need to have something like this, which forces the market to fall much further? We don't know, but it's something to keep an eye on. If the market continues up, we definitely need these two to completely recover. Okay, next one is NASDAQ versus the number of NASDAQ 100 stocks above their 50-day moving average. So NASDAQ is made a new all-time high over here, and you had like close to 90% of NASDAQ stocks at above their 50-day moving average. And then just recently we have NASDAQ is up near its all-time high again, but this time we have like 60, 62, 63, 64% of stocks above the 50-day moving average. So definitely a lack of participation. So NASDAQ 100 is 105 stocks or so. I forget the exact number. So when the number drops from 50 down to, or when it drops from 90 down to 60, we're talking about like 1/3 less stocks are participated in this rally. So it's definitely noticeable. It's definitely something to keep an eye on. You can see the divergence here induced this drop. Divergences at high levels are less powerful, but this one still produced this drop. And then, of course, going back to the virus, this is because of the virus. This drop was because of the virus, not because of the divergence. So this is definitely something we don't want to ignore. Okay, NASDAQ near its high, number of stocks above their 50-day moving average, definitely signaling less participation. All right, now we have S&P 500 up top. We have NYSE new highs. We have NASDAQ new highs. When the market is strong and healthy and trending up, you tend to just get a lot of up and down movement within a range. High prints can produce a high, but after it backs off, you tend to get a continuation. Divergences can signal short-term trouble too. So, and this is what we're getting right now. S&P, higher high, that's all-time high over here, but yet the number of stocks making a new high has declined, and the same thing at the NASDAQ. The number of stocks at a new high has declined. So something's got to give here. Okay, overall, like these oscillating movement, at a decent level is great for supporting the long-term nature of the chart, but within the long term, you get these divergences which can produce little pullbacks, and that's what we're getting right now. And the question is, was the pullback we got at the end of last week sufficient to work off the divergence that has built up? Maybe not. I think the course of action here right now is to be a little bit more cautious. Okay, bullish overall, but near term a little bit more cautious. All right, and here we're just one more chart to break it down. This is large cap new high, mid cap new high, small cap new high, just to see if there's weakness somewhere. And it turns out that the weakness is everywhere. So large cap new highs have been falling, mid cap new highs have been falling, small cap new highs have been falling. So it's not concentrated in any market cap. Basically across the board, new highs have been lacking, even though the S&P's hit a new high last week and the NASDAQ is right at its high. So we need improvement here. Okay, if the market's going to continue up, if it's going to continue up here, we definitely need an immediate expansion here. Otherwise, mathematically it just can't last. Okay, in the near term, you can have a bunch of larger companies pulling the index up over here, while a bunch of smaller companies don't participate to the same degree. But eventually, that internal negative pressure builds up and causes the market to drop. So this is definitely something to keep an eye on. You don't want to ignore this. Okay, so overall the market's in good shape. The indexes are obviously in long-term uptrends. Beneath the surface, the advanced decline line, advanced decline volume lines are supportive. New highs have fallen off. The question is whether the recent dip we got was enough to work off the divergence, or if more downside is needed. And stocks above certain moving averages have also fallen off. So has this situation been worked off? That's the big question right now, is that the indexes are doing well. Breadth is hinting at internal deterioration, and the question is, like, have we gotten enough of a move down to believe that the charts have been reset and we can start over, or is there still internal pressure building that needs to be worked off? Okay, so my overall bias is to the long side, but near term I'm being a little bit more cautious. I'm long, but I'm not taking big chances. All right, thanks for watching. I will see you next time.